Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Giles Gale and Jan Nevruzi. We've had another busy week of central banks, I guess, namely, certainly for this podcast, the Fed and the Bank of England. So let's start with the Fed, Jan. What were the key takeaways from this week's meeting?
This week's meeting was really broken into two parts. We had a very dovish statement at the beginning, and then a press conference from the chair, which was on the complete other end of the spectrum and was very hawkish. So let me just start with the statement. The main difference there was it was basically left unchanged with the addition of one sentence that pretty much said that going forward, the FOMC will consider the impacts of the tightening that's already been delivered, and they will also consider the lags in monetary policy. We already knew that, but that was a very deliberate insertion that means that maybe there's some dissents within the committee that Powell wanted to kind of like satisfy, or maybe there's a coordination with global central banks to kind of like add a little bit more of a dovish undertone to it. We don't know the reason. The minutes will certainly be very interesting in maybe giving us a little bit more around why that was put in there. Of course, they always consider the impacts of monetary policy tightening, and they of course know that monetary policy works with lags. But adding that there was like I said, very deliberate, and they 100% knew what the market impact would have been, which was an immediate rally in stocks and fixed income securities. So that was the 2 p.m. release. Markets took some time to digest it, but the overall expectation was that they're signaling a step down to 50 basis points in December by slotting that in, kind of adding this softer language into the statement. As the chair came to as he got to the stage and started fielding questions, I believe the dynamic entirely shifted. Right, so he was while he did say that they will consider the impact of hikes already delivered, Powell's focus was very much so on, listen, don't focus on how fast we're going. Keep in mind that we might have to go a little bit further. We might have to hike more than we signaled at the September meeting. Each quarterly meeting, the Fed releases their so-called dot plots, where Fed members will present their forecasts alongside their expectation of interest rates for the next few years. And the peak for next year was 4.6%, basically. Now, Powell said that rate is likely to go higher. We could see it going, for example, by another 25 basis points. But given that there could be some disagreements within the board, maybe some of the more dovish members are focusing a little bit more on macroprudential risks or something, unintended consequences of some sort. So maybe we get a little bit of a wider dispersion in these thoughts, which I don't want to put too much spin into the meeting. It was definitely, on net, it was certainly more hawkish than what we got from the rest of the central banks until now. But that being said, they commit to slowing down to 50, and then they say, well, we might have a little bit more next year to come, but next year, no one knows what we have a lot more certainty what's going to happen over the next few months, and we don't know what would happen next year. So if anything, that's kind of kicking the can down the road, and we might get them, we might not. Our in-house forecast has been that they indeed would have slowed down to 50 in December and hike 25 basis points 2 more times in 2023, bringing the rate to 5%. But we just were caught a little bit, we didn't see them committing to it at this meeting. Rather, we thought, why not wait for the CPI print next week and see how that comes and not lock yourself in a position? What if it accelerates and then you have to maintain this pace, right? So that was the one surprising thing. But like I said, minutes will be certainly interesting, and market has repriced terminal to about 5.2% as we're recording this, so slightly above where we think even the dots would signal. Of course, inflation could change a lot of that, and we'll get more data until then too. But it was on the margin. It was, I would say, a hawkish delivery by the chair, but which was start off by a very soft statement. So kind of like one of our colleagues pointed out, it felt like the Fed wanted to have the cake and eat it as well, and sure looks like they did that.
So, yeah, I guess the upcoming inflation data and jobs data is super important, and we'll get onto that in a sec. But just to conclude what we learned from this week, that hasn't changed your base case call for the Fed then. You're still looking for 50 at the moment, obviously with the caveat that they are going to be data dependent, and let's see what happens over the next couple of weeks. Is that correct?
Yeah, that's right. We are looking for 50, but they will have CPI next week. They're going to have another round of CPI, set of CPI numbers as they're in their December blackout period before the meeting. So markets will get data, but they're not going to get Fed member reaction. So, prepare for a little bit more drama around there. Of course, we're all hoping for inflation to decelerate, but it certainly is not looking like a sure thing. And like I said, we think 50 is going to be the move in December, but it's not a lock by any means.
Okay, so let's, I guess, go a little bit more into detail on that inflation print then. What are you expecting, at least for the next print, and how much of an upside surprise does that need to be, or downside surprise even, does that need to be to materially kind of alter the trajectory for the Fed, do you think, beyond that 50 basis points in either direction?
Yeah, and us and most forecasts are now showing a little bit of a softer inflation expectation compared to the previous month, particularly like on the core side. And that really comes down to things like the data we have around used car prices indicate that there's going to be some weakening there. We also know that the way for example, medical component of within CPI is constructed, it kind of has like an annual term that's derived from the retained earnings of insurers, and that's almost that resets basically once a year. October is going to be the next reset, so this month's number, and that will lead to a little bit of a drag in inflation as well. Both of those things could kind of led us to our forecast of about 0.5 on core, 0.6 on headline. So more or less in line with market, and more importantly, what the Fed would need to change their direction. I think 50 basis points for December would be consistent with market expectation for inflation, which is 0.5 on core. But if we see acceleration again, I think 75 comes back really, really quickly into the debate, and stepping down to 25 just feels not really this meeting's business. There's no point in saying that you're going to hike rates for longer and kind of get to a higher terminal rate and then step down to 25 basis points. You're simply not going to do it in that case. So and some of these, we've talked about how things like shelter, like the OER rent, are a little bit lagged and are causing inflation to remain high. But even if you exclude them, core services across the board are running about that pace at like 0.6, 0.7. So it's not just rent that's doing this. It's there's a broad-based inflation services, and it's going to be really hard to see that coming back down to target anytime soon, or decelerate fast enough for the Fed to say, all right, we're good. Maybe unemployment will be the next thing that kind of causes them to reevaluate what they should be doing, if they should be slowing down, pausing, reevaluating what the hikes so far have done. So let's say 1 month you get negative $200,000, negative 200,000 jobs, right? That could be something that changes the mindset of people, because it's easier to make these hawkish statements while unemployment drifts lower, growth still remains firm, and inflation is high. So I think there's something to look out for, but base case, what the market gets, I think, pushes the Fed down to only 50 basis points. But it wasn't just the Fed this week. We also had the BOE today. So do you want to give us a recap? How does that leave your rates view?
Yeah, I think, well, there was a bit less, I suppose, divergence between what the BOE said in their statement and then what they said in their presser. They seemed a little bit more consistent, let's say, than Powell did yesterday. I think overall you would probably classify this as a fairly dovish meeting. I mean, on the surface, it was a 75 basis point hike, which is obviously the largest hike that the Bank of England have done for some time, but very much in line with market expectations. The vote was 7-2 as expected, but a little bit more of a dovish skew on that vote, in that one of those two dissenters was actually a vote for 25. So it was one vote for 25, one for 50, and 7 for 75. And I suppose the two most dovish elements that they delivered then, alongside what the market was broadly expecting when it came to the rate hikes, was that there was a collective pushback on market pricing of bank rate expectations. Now, this isn't necessarily new, because obviously we know that Broadbent sort of explicitly pushed back against market pricing just a couple of weeks ago. But to have it in the statement seems as though it's a view that the committee has sort of unanimously signed up to. Now, that view is kind of caveated by the fact that my interpretation here is that they're talking about bank rate that was priced into their forecasts and their projections, which is a little bit different to bank rate expectations today. They were talking about peak bank rate at 5.2, and we've already had a lot of that repricing. We're now at bank rate expectations peaking at around 4.6, 4.7 in the UK. So I don't think that they were necessarily pushing back significantly on where we are today, but where we were, say, 2 weeks ago, which, I think was fairly consensus that seemed pretty toppy. And the other dovish element was to do with the projections. So this was one of the quarterly monetary policy reports where we get their updated growth and inflation projections over a 2 to 3 year horizon. And the bank projections, as they did in August, but even further revised down since the August update, they saw inflation well below their target on a 3 year horizon, and that's in both a constant rate and a market rate projection. So what they do is they keep rates constant at 3% and say this is what inflation would be, and then they use market rate expectations and say this is what inflation would be. But nonetheless, in both of those scenarios, they were well below their 2% target on the 3 year horizon. Yet on the other hand, they were still suggesting that rates needed to rise further, just perhaps not as much as the market was pricing in. Now, since the August meeting, both the market and the Bank of England have kind of disregarded the forecast to a certain extent. And part of that is because both times that they've done their monetary policy report projections, they haven't had the luxury of having kind of full visibility over the fiscal plans of the government. As we know, the budget was supposed to be this week and that's now been delayed. So they can't make those projections or make policy based on unannounced government policy. So clearly there's some measures that we're all expecting to be announced that weren't included, which may help to, we're expecting those to be kind of spending cuts and tax hikes rather than the fiscal stimulus that we were expecting just a couple of weeks ago. So that may help to kind of counteract some of the rhetoric that we see today. But nonetheless, that's probably a lot of that kind of tightening of fiscal policy is over a longer term time horizon than the Bank of England's projections themselves, and certainly longer than the next kind of 6 to 12 months, which I think is what they're very much focused on. So a lot of moving parts, but overall a fairly dovish meeting, but probably not one that was dovish enough for the market, given that they're still telling us that bank rates still needs to rise. Quite probably, at least another 100 basis points higher than here, we think. And I think given just the kind of rhetoric in the last 10 days with global central banks kind of pivoting, if you like, although as we've discussed on this podcast before, I think pivot's probably not the right word, but I think that there was probably quite a high bar for the Bank of England to outdove the market, and that explains the kind of higher yields and steepening curve that we were seeing as Bailey was talking. And just to round off that discussion, it hasn't changed our base case. We were already a bit more dovish than the market in terms of where we saw kind of peak rates in this cycle. So we haven't changed our base case of seeing another 75 basis points in December, 50 basis points in February, and that brings the peak to 4.25. I think that hike in December, there's probably downside risks to that. So risks to 50 basis points. But it's not obvious to me that if they felt justified in stepping up rates from 50 to 75, that any of those factors that would have justified the step up in rates will have reversed sufficiently to justify a step down again back to 50 in December. So for now, we stick with our base case, another 75, another 50, and terminal rates at 4.25 by February.
Right, that makes sense. And I have another question for you. And for people who are not really into the nitty-gritty of, I guess, financial plumbing, this understandably comes off as a very, well, how could it be? But there is a collateral shortage going on in the UK, Europe, and somewhat in the US. And of course, with all the government issuance, you would think that wouldn't be the case, but it just happens to be so. So has the BOE done anything around the shortage in the UK, or anything forward-looking that you can share with us today?
I feel like I'm stealing Giles's hat on the podcast now. This is usually his kind of thing he'd like to discuss. But yeah, I mean, we have discussed this on the podcast through the European lens in the last couple of weeks, but there's been a similar dynamic in the UK that's sort of been exacerbated by, the stress that we saw at the long end of the curve a couple of weeks ago related to, LDI and the fact that they've then sold a lot of assets and have high cash balances, which they've been putting to work. So there is this collateral scarcity in the UK as well. And that is something that has been causing stress in the markets in the last couple of days. It's something that we've been talking about a lot in the last couple of days. And there was some speculation going into the meeting that the Bank of England may well be thinking about doing something that might alleviate some of this pressure. Now, you mentioned, Jan, that there's a lot of supply coming on board, and obviously you have QT as well in the UK that you would think should help to alleviate some of this collateral scarcity. But actually in the UK, the supply that we have, particularly between now and the end of the year, is really concentrated in the belly of the curve. And QT, as we know, although it's concentrated at the front end in that they're not selling the very long end bucket, they also aren't selling the 0 to 3 years. They're letting that roll off naturally. And that's where the kind of stress is really being felt in that very front end of the market. No one asked about this in the press conference, but I thought it was quite interesting that when asked only really one question about QT at the very end of the press conference, Bailey and Ramsden used the opportunity, although the question was totally irrelevant to the way that they answered it, they used the opportunity to kind of highlight the fact that they're obviously monitoring the funding, the stress in the funding markets that they're seeing. And the tone of their response to me, and perhaps I was kind of reading into it a little bit too much, but suggested that this was something that they were thinking about what else that they could be doing. And what else might that look like? Well, simply, I think it could be that they just actually choose to sell those bonds in the very front end bucket. So perhaps they, extend the maturity of that front end bucket to just be 1 to 7 year perhaps, and start to sell some of those very shorter dated bonds back to the market. This week was also quite important by the fact that we had the first QT kind of active sales auction. And if anything, I think that was characterized by the strong demand that we saw for the very shortest bonds, those bonds that are on the kind of cusp of the 3 year sector. And so that's very indicative, I think, of the strong demand and probably the success that the Bank of England would have if they did just set up some shorter auctions. But perhaps that's a bit of a longer term solution for now, and maybe something that we might be talking about closer to the December meeting and the year end turn. So with that, perhaps we can move on to Europe. Maybe not quite as busy given that the ECB was last week, but we have had plenty of ECB speakers this week, which we will get onto. But perhaps first of all, we can just talk about, everything, Giles, that's happened in the US and the UK this week. What does that mean for the European curve?
So the basic answer is that we've been dragged higher, along with everyone else, with sort of something like a 65% pass through, which I think more or less makes sense. Clearly at lower rates, volatility should be a little bit lower, but at the same time, something I'm struck by is that we are approximately the same distance from where we are now in front-end rates to where markets seem to think that the terminal rate is. Of course, they expect to get there a little bit faster in the Anglo-Saxon economies. Okay, so that also contributes to higher volatility there. But overall, I think that the European markets have broadly done what you would have expected And one thing maybe to just highlight about the dynamics is we seem to have moved to a broadly sort of parallel dominant dynamic at the moment, which suggests, yeah, there's a front end element, but we are being dragged along by other markets.
I think it would be a bit remiss of us to not talk about the ECB this week, particularly today. We're recording this on Thursday when there's been so many ECB speakers on the docket. What have we learned from everything that they've said, I suppose, since the meeting last week?
Okay, I mean, not a great deal, I would say. I think that the main speaker today, and actually significant as well, because we haven't really heard a great deal from the doves, and particularly not speaking dovishly in the last few weeks. But today we had Panetta, who opened a conference on money markets, and Panetta, he's pretty pivoty, he's pretty dovish. He was more or less pushing it from that side. Again, really pressing this notion that we need to start thinking about the lagged effect of what's already been done. We need to make sure that we don't overcook it. You don't want to be where the Bank of England seems to be saying in its projections that it's going to be where you're fighting deflation in a year and a half time. That would be a pretty disastrous outcome. Although he doesn't quite put it like that, of course. So yeah, I would say broadly what you would expect from him. One thing that I thought was a little bit interesting was what he said about quantitative tightening, which is so quantitative tightening is going to be it's going to be one of the key things for the December meeting, where we're told that we will be expected to get a sort of statement of high-level principles or something like that about how they're going to move ahead with quantitative tightening next year. Well, he has kind of anticipated that by giving a view. I presume, just trying to anchor the debate a little bit. What he was saying was that they want to wait for the absorption of the impact of the TLTRO repayment, and then broadly after that we'll be talking about a sort of capped runoff. Now, I thought that was interesting because that doesn't seem, in my mind, to push things back too far, because if you're going to have TLTRO repayments basically in November, then we might have a decent sort of that'll come through and settle down early next year. I mean, January, February, that should wash through.
Okay, so it could be a pretty early start for QT then, perhaps. Perfect timing.
Leading question, well, perhaps. Listen, we always thought that it was a Q1 theme. It seems like it's maybe been pushed back to Q2, but I think it's sort of late Q1, early Q2, that sort of time frame.
Okay, so in terms of things you're watching out for then, I guess, in the Euro area, is that the key thing that you're watching over the next couple of weeks, more rhetoric around QT? What else is going to be on your radar?
Well, yeah, absolutely. I think the money markets are a super important one. So
I told you it was your topic.
always. No, but listen, they're fascinating. TLTRO repayments, we'll be building up to that over the next 3 weeks, and that will that'll keep us busy. I dare say we'll have hopefully a little bit more of a view from other ECB speakers about how they feel about quantitative tightening, in addition to Mr. Panetta. Then, of course, I guess we're looking at how supply is being taken down, because there will be obviously a significant amount more. We're still in early November, but at the same time, liquidity is deteriorating still, and it will only continue to deteriorate presumably into December. So I think that just watching how all of that progresses is going to be important. Big thematic things, not so much. I mean, obviously we're watching the data, we always are, but at this point, what are we looking at? I mean, inflation, wages in particular, that we will be watching how that develops in Germany into the slowdown, but given the strong cost pressures that we've had so far, so there are some important negotiations which are still ongoing there. We may get some information around that. The German labour market data actually this week, kind of lost in the avalanche of other things that was going on, was actually better than expected. So maybe a small indication that that's still something which could surprise us on the upside for inflation expectations. There's SGP reform, that is Stability and Growth Pact sort of review that needs to come out at some point, and so that will also help to frame the debate about where we're going with supply, fiscal situations and so on into next year and beyond. And maybe just the final point to make about all of that is that quantitative easing has still been actually pretty present in Europe, because the ECB has been, it seems to have shifted some of its weight of reinvestment from earlier this year into later this year, but that's going to go away again next year. So I think that taken together with the possibility of quantitative tightening and all the supply that we think is going to be coming and hitting us next year, and I think that will keep my markets focused on the core view, which is still bearish.
All of that sounds like an answer from someone who's been thinking very carefully about the themes for the year ahead. So a lot to watch over the next
Not carefully enough, Imogen.
Okay,
anyway.
Well, let's get back to it then. We've got a deadline looming, which I'm sure our listeners will be happy to hear about. So let's leave it there this week, and I'm excited to catch up on all of those things in the weeks to come. Thank you both for joining me, and just a reminder to our listeners that if you like today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, see you next week.